It wasn't a clerical error, it wasn't a rogue trading algorithm gone wrong, it wasn't even a simple case of corporate greed, it was a structural inevitability. A defensive fortification built in plain sight, the arithmetic is merciless, the pattern is unmistakable. When the most sophisticated financial institution in the modern world quietly positions itself as the ultimate custodian of the most undervalued monetary asset in history, you are not watching a gamble. You are watching a hedge. You are watching the architects of the dollar system preparing for the end of the dollar system. For years, market observers have tracked the movements, the warehouse receipts, the custodial transfers, the reclassification of eligible versus registered inventory. The accumulation is staggering. Estimates regarding the physical silver held within the vaults of JPMorgan Chase, both for its own account and as the custodian for the largest silver exchange-traded fund, suggest a hoard approaching 750 million ounces. To put that number in perspective, that is roughly equivalent to an entire year of global mining production concentrated in a single network of vaults under a single corporate umbrella. Why would a bank built on fiat currency, a bank that thrives on the velocity of credit and the issuance of debt, corner the market on a physical metal that yields no interest? The answer lies in history. It lies in the blueprint established over a century ago. It lies in the transition from the hard money of the 19th century to the elastic currency of the 20th. This isn't prophecy, it's positioning under constraints. To understand the mechanics of this accumulation, we must look away from the daily price charts. We must ignore the noise of the nightly news. We must look at the incentives that drive the titans of finance when the ground beneath them begins to shift. We have seen this behavior before. We have seen the elite front-run a monetary reset. We have seen the quiet accumulation of real assets before a statutory devaluation. The history of high finance is not a history of random events. It is a history of insiders managing the collapse of the systems they created. Current data suggest we are approaching another such inflection point. The liquidity is drying up. The debt loads are mathematically impossible to service at positive real yields. The incentives are aligning for a repricing of all tangible collateral, and the entity with the largest stockpile of collateral wins. The strategy is not new. It was written in 1913 and it is being executed again today. Pause. To understand the gravity of the current moment, we must first examine the architecture of the original transition. We must go back to the first case file, the Panic of 1907 and the subsequent creation of the Federal Reserve System in 1913. This was not merely a legislative event. It was the greatest consolidation of banking power in human history, and it established the rules of the game that are still being played today. The context of the early 20th century was one of chaos and opportunity. The United States was an emerging industrial titan, yet its banking system was a patchwork of state-chartered institutions and national banks, all vulnerable to seasonal liquidity crunches. The Panic of 1907 was the catalyst. It was a liquidity crisis that threatened to freeze the entire American economy. Trust evaporated. Depositors demanded gold, and the banks simply did not have it. The New York Stock Exchange nearly ceased to function. In that vacuum of authority, JPMorgan, the man, not the bank, stepped in as the lender of last resort. He locked the leading bankers of New York in his library and refused to let them leave until they had pledged the capital necessary to keep the trust companies afloat. It worked. The panic subsided, but the lesson drawn by the elite men like Nelson Aldrich, Paul Warburg, and the Rockefeller interests was not that JPMorgan was a hero. The lesson was that the system was too fragile to rely on the health of a single mortal man. They needed a permanent, institutionalized version of JPMorgan's library. They needed a central bank, but they faced a constraint. The American public was deeply suspicious of centralized power and Wall Street cartels. The incentive, therefore, was to create a central bank that appeared to be a government agency, but functioned as a private backstop for the banking cartel. This brings us to the famous meeting at Jekyll Island in 1910. The secrecy was paramount. These men traveled under assumed names, claiming they were going on a duck-hunting expedition. The plan they drafted, the Aldrich Plan, which eventually mutated into the Federal Reserve Act of 1930, was a masterstroke of positioning. It allowed the banks to monetize their own debt. It created a mechanism where reserves could be pooled and deployed to solvent but illiquid banks, preventing the kind of contagion seen in 1907, but crucially, it severed the strict discipline of the gold standard while gold remained the backing. The new Federal Reserve Note introduced elasticity. It allowed the supply of money to expand to meet the needs of commerce or the needs of the banks. The Rockefeller blueprint here was the understanding that control over money creation was more valuable than the money itself. By controlling the interest rate and the supply of credit, the new Federal Reserve could amplify booms and cushion busts for the insiders. While the costs of inflation were socialized across the entire population, the shift was subtle but profound. Wealth was no longer just about owning land or gold. It was about proximity to the credit spigot. Those who understood this positioned themselves accordingly. They moved out of low-yield fixed income and into industrial monopolies that could raise prices during the inflationary periods that the new system would inevitably create. They understood that the dollar was now a managed currency, and its value would be determined by policy, not just geology. This 1913 transition teaches us the first rule of elite positioning: change the structure of the market to ensure your survival, then position yourself at the bottleneck of the new system. Pause. Fast forward 20 years to our second case file, the gold confiscation and revaluation of 1933-1934. If 1913 was about creating the machinery of inflation, 1933 was about using emergency powers to reset the system when that machinery stalled the constraint facing the Roosevelt administration. And the banking elite in 1933 was the deflationary spiral of the Great Depression. The credit bubble of the 1920s had burst. Prices were collapsing. Farmers were burning crops because they cost more to harvest than they could sell for. The banking system was insolvent because the assets on their books, loans and mortgages, were going bad while their liabilities, deposits, were owed in gold-backed dollars. The math didn't work. The incentive was to devalue the dollar to inflate the price of assets and relieve the debt burden, but there was a problem. The gold standard, as long as citizens could redeem paper dollars for gold coin, the government could not print money freely without draining the Treasury's gold reserves. The constraint was physical gold in private hands, the positioning of the elite during this period is instructive. While the average American was waiting in breadlines, sophisticated players saw the writing on the wall. They understood that the government's need to inflate was greater than its respect for property rights. Bernard Baruch, a financier and advisor to presidents, famously advocated for holding gold, but he and others also understood the risk of seizure. The smartest money moved capital offshore or into assets that would benefit from a revaluation. On April 5, 1933, Franklin D. Roosevelt issued Executive Order 6102, forbidding the hoarding of gold coin, gold bullion, and gold certificates within the continental United States. Citizens were ordered to turn in their gold to the Federal Reserve in exchange for $2,067 in paper currency per ounce. This was framed as a patriotic duty to stop hoarding. Here is the key mechanism that is often overlooked. The government did not just seize the gold to sit on it. Once the gold was secured in the Treasury, the government revalued it. In January 1934, the Gold Reserve Act was passed, and the president raised the statutory price of gold from $2,067 to $3,500 an ounce. Think about the arithmetic of that move. The government forced the public to sell at $2,067, then immediately declared that same gold to be worth $3,500. This was an instant devaluation of the dollar by roughly 40% and a massive bookkeeping profit for the Treasury. This profit was used to capitalize the Exchange Stabilization Fund, giving the government a slush fund to intervene in currency markets. The insiders who had moved their wealth into foreign currencies or foreign-held gold before the seizure made a fortune. Those who held paper dollars lost 40% of their purchasing power in gold terms overnight. The lesson from 1933 is brutal but clear. When the sovereign debt burden becomes unbearable, the rules of ownership change. The state will prioritize its own survival over your property rights, and the mechanism of the reset is often a sudden discontinuous repricing of the monetary metal against the currency. Pause. This brings us to our third case file, which illuminates the dangers of trying to corner a market against the wishes of the establishment. The Hunt brothers and the silver crisis of 1979-1980. The constraint in the late 1970s was the great inflation. The U.S. dollar was under siege. The link to gold had been severed by Nixon in 1971, and inflation was running into the double digits. Trust in fiat currency was at a nadir. Oil prices were skyrocketing. The incentive for wealthy individuals was to flee paper money and buy hard assets. Enter Nelson Bunker Hunt and William Herbert Hunt, Texas oil tycoons who feared the total collapse of the dollar. They decided to hedge their fortune by accumulating physical silver. They believed that silver was historically undervalued relative to gold, and that the industrial demand for silver exceeded the supply. They began buying. By late 1979, the Hunt brothers and their associates controlled a massive percentage of the world's deliverable silver. The price exploded from $6 an ounce in early 1979. Silver hit an intraday high of $5,035 in January 1980. The Hunts were sitting on billions in paper profits. They were effectively squeezing the short sellers, many of whom were bullion banks and establishment insiders who had bet on the price staying low, but the Hunts made a fatal error. They assumed the market was a free market. They failed to account for the constraint engine of the regulatory state. The establishment, the Federal Reserve under Paul Volcker, and the exchange regulators at the COMEX saw the silver spike as a threat to the stability of the financial system and a symptom of inflation. Psychology, they were trying to crush. The rules were changed in the middle of the game. On January 7, 1980, the COMEX changed its leverage regulations. Then on January 21st, they announced that trading in silver would be limited to liquidation only. This meant traders could sell silver to close out positions, but they could not buy new silver. The arithmetic of a liquidation-only market is obvious. If you can only sell and not buy, the price must collapse, and it did. Silver crashed. The Hunts were issued massive margin calls they could not meet. They were forced to liquidate their holdings at fire sale prices, bankrupting them and nearly taking down several brokerage houses with them. The lesson here is critical for understanding the modern context. The Hunts were outsiders. They tried to corner the market using leverage, and the establishment changed the rules to break them. But notice the difference today. The entity accumulating the silver is not a Texas oil wildcatter. It is JPMorgan Chase. It is the establishment itself. It is the bank that acts as the custodian for the SLV ETF. It is the bank that serves as a primary dealer for the Federal Reserve. When the Hunts bought silver, it was a rebellion. When JPMorgan accumulates silver, it is a strategic reserve. The difference is not the asset. The difference is the position of the player within the power structure. This leads us directly to the constraint engine driving the current behavior. Why is this happening now? Why the accumulation of 750 million ounces? The constraints facing the modern financial system are visible to anyone willing to look at the balance sheets. We are in the late stages of a long-term debt cycle. The global debt-to-GDP ratios are higher than they were during the Great Depression or World War II. The central banks have printed trillions of dollars, euros, and yen to keep the system liquid, but this has created a massive overhang of currency. The incentive for a bank like JPMorgan is to hedge against two specific risks: the return of structural inflation and the implementation of Basel III capital requirements. Basel III is a global regulatory framework that changed how banks classify assets. Under the new rules, allocated physical gold and silver are considered Tier 1 assets, risk-free, just like cash or treasuries. Paper gold and unallocated accounts are not. This creates a powerful regulatory incentive for banks to hold the physical metal rather than paper derivatives. It turns silver from a speculative commodity into a high-quality banking reserve. Furthermore, the industrial constraint is tightening. We are undergoing a global transition to green energy. Solar panels require silver. Electric vehicles require silver. The physics of conductivity makes silver irreplaceable in high-tech electronics. Estimates range, but many analysts argue that industrial demand is consuming the vast majority of annual mining supply. We are entering a period of structural deficits in the silver market under these constraints. The rational move for a dominant financial player is to secure physical supply. If you control the physical metal, you control the collateral. And in a world where paper assets, bonds, and derivatives are becoming increasingly volatile, he who holds the collateral sets the price. Let us map this onto the present day. The 750 million ounce figure is derived from analyzing the inventory reports of the COMEX and the custodial holdings of the SLV ETF, while JPMorgan acts as the custodian, meaning they hold the metal on behalf of ETF investors. The line between custodian and owner can become blurred in a crisis. Legal precedents regarding bail-ins and custodial rights in bankruptcy are complex and untested at this scale. But the pattern suggests a dual strategy: first earn fees as the custodian of the world's silver, second possess the physical optionality if the price of silver is reset, much like gold was reset in 1934, the entity holding the metal benefits. If the industrial supply chain breaks, the entity with the stockpiles becomes the kingmaker. For the technology sector, current data suggest a divergence. The paper price of silver on the futures markets is often contained while the premiums for physical coins and bars remain high. This decoupling is a classic sign of a market under stress, where the paper claims on the asset exceed the available physical inventory sum. Observers argue that this is simply standard market making. They say JPMorgan holds this silver merely to facilitate trading for clients. This is the counterargument that a bank is a flow machine, not a vault, but this ignores the scale. You do not accumulate a year's worth of global production just to facilitate flow. You accumulate that amount to dominate the market. The incentive structure of a too-big-to-fail bank is to ensure that no matter what the currency does, their balance sheet remains solvent. If the dollar collapses, silver rises. If the dollar strengthens, they hold a strategic industrial asset. It is a win-win, provided you have the capital to hold it. Pause. We must consider the endgame's history suggests three paths forward from this level of debt and monetary saturation. The first is controlled decline. This is the path of financial repression. The central banks keep interest rates below the rate of inflation for a decade. This slowly transfers wealth from savers to debtors, the government. In this scenario, silver and gold perform steadily as inflation hedges. The accumulation by JPM would serve as a ballast against the slow erosion of their fiat loan book. The second path is chaotic collapse. This is the loss of confidence event, a failed bond auction, a geopolitical shock, or a sudden realization that the debts cannot be paid. In this scenario, liquidity evaporates, derivatives chains break. Counterparty risk becomes the only thing that matters in a chaotic collapse. Possession is 10/10 of the law. A warehouse receipt is only as good as the legal system enforcing it. Physical metal in a vault is absolute. JPMorgan's positioning here is a hedge against the systemic failure of the paper markets they themselves operate. The third path, and perhaps the most likely given the historical precedent of 1933, is reset and restructure. This involves a formal change in the monetary system. It could be the introduction of a central bank digital currency, CBDC, or a revaluation of gold to recapitalize central bank balance sheets. In a reset, the price of precious metals is set administratively higher to extinguish debt. If gold is revalued to, say, $15,000 an ounce to cover the monetary base, silver would likely be dragged up with it or revalued on its own merits as a strategic asset. In 1934, the government captured the profit of the revaluation today with the Federal Reserve and the Treasury. So, intertwined with the primary dealer banks, the line between government and bank is porous. A revaluation that saves the Treasury would also need to save the banking system. Holding the hard asset is the ticket to the table when the new system is negotiated. Pause. The pattern is clear from the library of JPMorgan in 1907 to the vaults of JPMorgan Chase today. The players change, but the mechanics of power do not. The accumulation of hard assets by the architects of the fiat system is the ultimate signal. It is a signal that the current cycle is ending. It is a signal that the smart money is moving from the abstract to the concrete. They are not betting on a gamble. They are positioning for a certainty. The only variable is timing and paying. Subscribe.